When earnings season hits, public attention immediately fixates on the top floor of the global economy, mega-cap tech giants like Apple and Microsoft. We treat their massive revenue figures as the standard metric for economic health, but headline numbers are lagging indicators. They tell us exactly what happened last quarter, but offer very little about the path ahead. Right now, the markets are navigating a complex intersection of anxieties, like persistent inflation, elevated interest rates, and a rapidly escalating AI boom that requires tens of billions of dollars in new investment every single quarter. Diagnosing whether this global tech market is stable or heading for a correction requires analyzing a specific interconnected sequence of earnings reports. To do that, we use this four-tiered pyramid to map the structural economic stack. We have to apply a bottom-up approach. We need to trace a single dollar of capital investment, starting at the invisible, foundational base of the tech supply chain, and follow it all the way up through the hardware and software layers until it finally reaches everyday consumer wallets. Mapping this interconnected architecture reveals whether these massive AI investments are building a sustainable economic engine or a significant financial risk. We start by looking away from Silicon Valley software and dropping down to the absolute base of the global supply chain, Layer 1. This is the domain of companies like KLA and Lam Research. These companies do not manufacture microchips. They engineer the highly advanced, multi-million-dollar fabrication machines required to physically print and etch those chips at microscopic scales. When major fab operators like TSMC or Intel place huge orders with equipment makers like KLA, they are signaling long-term structural confidence. They are committing serious capital to build worldwide chip capacity years in advance. Conversely, when advanced manufacturers cut their equipment orders, they are actively bracing for an economic slowdown and pushing back their expansion timelines. Once we understand Layer 1, we can move one step up the stack to Layer 2, where that raw manufacturing capacity is translated into physical AI components. This is the level of SK Hynix and Seagate. High-bandwidth memory chips from SK Hynix and data storage architectures from Seagate represent the physical reality of the AI boom. Watching their sales proves whether hyperscalers are actually expanding server capacity or simply increasing their orders for future use. Any margin pressure or slowdown in these hardware metrics flags potential inventory bottlenecks. This serves as a leading indicator of sector-wide stress, often signaling a cooling period before software companies even release their reports. Without the multi-billion-dollar flow of hardware moving through these two foundational layers, the entire AI economic narrative lacks the infrastructure to exist. That brings us up to Layer 3, the enterprise buyers purchasing all that hardware. Microsoft, Meta, and Amazon. There is significant financial tension at this layer. These tech giants are engaged in a capital expenditure arms race, pouring tens of billions of dollars into building out AI infrastructure. The stock market applies a strict requirement to these companies. Their massive capital outlays must yield corresponding tangible revenue expansion. Amazon has to show cloud computing growth, and Meta has to prove it can increase its digital ad rates. If capital expenditures surge while revenue softens, enterprise margins face heavy pressure. That dynamic is what typically rattles global tech valuations across the board. But even successful AI requires the stability of Layer 4, the foundational consumer economy. This dashboard displays a line graph of consumer credit volumes struggling against a ceiling of persistent inflation. Earnings from Visa and MasterCard act as a high-frequency lens into household balance sheets, showing how much pressure buyers are under. Hardware upgrades from Apple and industrial energy demand from ExxonMobil serve as the stress tests for this layer. They reveal whether the global population has the discretionary income and energy requirements to sustain further expansion. If consumer credit snaps or industrial production drops, the tech giants' AI investments risk being left stranded without a solvent end market to justify them. The global economy functions as a series of interlocking dependencies built on consecutive stages of financial confidence. Looking at the complete structure, we trace the causal chain. Foundational equipment enables hardware. Hardware powers enterprise AI, and those models require a robust consumer base to survive. A fracture anywhere, from delayed factory tools to credit card delinquencies, can trigger a systemic market failure. To understand where we're going, we have to look past the final consumer earnings reports that dominate the news cycle. True economic foresight requires listening to the obscure, invisible companies at the bottom of the stack. Their capital decisions dictate the pace and viability of the entire system.